I'm Cormac Leech from Liberum, an investment bank. We've been focused on marketplace lending for the best part of 3 years, about two and a half years. I want to talk a bit about how to invest in the sector. So here we've got some data plotting annual gross volumes in the US and the UK versus yields. And basically by 2016, we think that there will be annual gross volume available of about $40 billion. So big opportunity to invest. That's up from about $8 billion in 2014. So very rapid growth, as you've been hearing all morning. In terms of yields, we think that the yields will come down a little bit in the US, but will increase actually in Europe and the UK as institutional comes in and people are encouraged to, basically the platforms are encouraged to take more risk. So big opportunity on the revenue side. The question everybody has is how risky is this sector? If you read any media talking about the sector, everybody's focused on the risk actually. So we're looking here first at consumer finance marketplace lending. The blue bars here are the annual net yields available to investors in consumer finance. The green are the loan losses. So if you add them together, you can see the gross yield for each year. And what you can see is generally consumer finance has been an excellent asset class to invest in. It really is a new asset class open to institutional investors, non-bank investors. And I think what's interesting is if you focus on Zopa, I'm not sure if Giles is here, but if you look at Zopa, one of the few platforms to be up and running before the financial crisis, worst point of the crisis, still generated returns of 4.5%. That's very impressive by any standard. Worst financial crisis in 100 years, you still produce returns of 4.5%. So, this asset class is not particularly risky. On the SME side, I think the story is slightly different. You have to have a more targeted approach. If you look on the top left, you can see Lend Invest, secured property lender, UK-centric. Average net yield since 2008 of about 10%. And interestingly, zero loan losses. You'll see there are no green bars for Lend Invest. And they've produced very good returns. For Funding Circle, the story is slightly different, actually. You can see that the net yields, for example, the cohort in first half 2011, much lower at about 1 or 2%. And the green bars, the loan loss is quite a bit higher. So I would say Funding Circle still hasn't proven its underwriting processes through a full cycle. So I think in SME, you have to be a bit more targeted with your approach. So I've looked at the revenue opportunity and the risk. Here we're looking at how much alpha is there? How mispriced, fundamentally, is the big question, are these marketplace lending loans? How much excess yield is there available? If we look at the asset-backed security market, we can kind of imply what you would expect the net yields to be. And, we come out at estimating about 4 to 5% would be what you would expect the net yields to be from these loans. If you compare that with what you actually get, you're getting alpha of about 2 to 5% per annum. And we think, in theory, that should get eroded away over time. But actually, I think in practice, it will probably persist for longer than people expect. Here, we're really just making the point, this is not just about peer-to-peer. There are a whole bunch of other marketplace lenders, direct lenders, which don't take money from retail investors that are very high quality and well worth your attention. And, we can put you in touch with them if you want to get involved there. So we looked at the opportunity, and why is this sustainable? You've heard a bunch of stuff from Orchard and so on about sustainability, but here we're kind of just making the case. Looking at banking over the last 1,000 years, if you don't mind going back to Knights Templar in the 1100s, essentially before the internet, banking really was the best way to provide a secure communication network to the economy, and also to provide the economy with the credit information needed to make good lending decisions. Obviously, it's blindingly obvious, but the internet, obviously is a secure communication network, and guess what? There's a whole bunch of credit information available on the internet, and therefore, the conditions are there for a revolution in banking. And indeed, if we zoom in on the last 25 years, sure enough, you can see there's a whole bunch of fintech innovation in the payment space, in marketplace lending space. And, as Bank of England, Haldane is saying, banking is on the cusp of financial revolution, biggest reconfiguration for centuries. And, if you look at banking in the context of other adjacent industries, you can see incumbents starting to struggle elsewhere. And we'd argue, you will see that happen in banking over the next few years. In fact, you're starting to see the banks closing branches, in fact. So what is it? What is it that makes marketplace lending work now? What makes it very likely to grow substantially over the next decade, let's say? I would argue that it's really about the internet enabling marketplace lenders to get access to credit information. It's a massive leveling of the playing field versus banks that historically have relied on their own customer data to make lending decisions. So, you've got the credit scoring agencies, you've got the ability to scrape bank accounts using Yodlee. Xero coming out of New Zealand enables you to get real-time cash flow data on SMEs, and obviously you've got big data. So this is an absolute game changer, and it underpins the marketplace lending revolution. So other reasons marketplace lending is sustainable, I mean, a lot of you will have seen this chart on the top before. It's the comparison of the bank costs of underwriting versus marketplace lending, about 60% more efficient for marketplace lending. And then on the bottom, you've got the whole government support for the sector. I mean, in the UK particularly, the UK government is very supportive of the sector, firstly because it reduces systemic risk, it reduces the too big to fail problem, and also they see it as a critical way to channel funding to credit-starved SMEs, thereby boosting economic growth. So for all these reasons, we think the sector is clearly sustainable. Now, obviously, there are very material risks that we think are building. The first one is we think that the platforms don't have sufficient skin in the game. I'm sure a lot of you will remember investment banks in 2007 originating a whole bunch of subprime mortgages that went horribly wrong. I would argue that a lot of those preconditions are currently present in marketplace lending, unfortunately. And I think the easiest way to solve it is to require the banks to invest some of their own lending capital pari passu with the other lenders on the platform. The other way to solve it, frankly, is to get the SMEs, the CEOs, to have their compensation linked to some kind of minimum annual net yield on the platforms. And the other big risk we see emerging in marketplace lending, particularly in the UK, is lack of transparency. We're seeing some of the UK platforms under the kind of mantra of simplicity for retail investors, frankly, not really giving enough information on where the loans are actually being made. Not enabling, if you put retail money in, to see actually where the money is going and enabling you to understand what risk you're taking. So we think transparency absolutely critical to making the sector viable over the next 5 or 10 years. In fact, transparency, we think, is an emerging point of differentiation. If you look, you can't really see because of the chairs, but if you look on the left-hand side, we have some of the platforms that are very transparent, and Funding Circle would come into that category. At the other extreme, you've got companies like Wellesley. Maybe we can touch on that later, but they're less transparent in terms of how much information they're providing to platforms, to retail investors. And we would encourage the platforms to be as transparent as possible, not particularly because they are not kind of behaving well, but to basically raise the bar and force new entrants to be very transparent about what they're doing to protect the sector from contagion risk. If you have one platform who comes in and behaves badly, it can affect the whole sector. So despite all those risks, what we're clearly seeing are the incumbents investing aggressively in the space. We're seeing, particularly in the last year, you're seeing banks invest. You're seeing former executives coming into the space. Obviously that bodes well because the incumbents, if anybody, are best positioned to understand the opportunity in the space. So how to invest? Well, if we do a kind of top-down type analysis, we reckon that the sector can be worth about $250 billion about 10 years from now. That's conservative, frankly, and it's based on some relatively conservative assumptions about market shares. But in the context of current valuations, it implies quite a bit of upside. So what listed equity investments are available today? Well, at the top, we've got two funds, PTBGI and GLI Finance. You'll hear more about those in a little bit from Simon and Jeff. I think PTBGI is particularly interesting because it's trading, in fact, remarkably at a premium to NAV, trading on 1.1 times. And that's despite having only half of its cash invested. So we'd argue, as cash becomes invested over the next 3 or 4 months, that premium to NAV is likely to increase. Now, PTBGI is more geared towards debt. It's about 95% debt, marketplace lending debt, and about 5% equity. GLI Finance, on the other hand, has about 30% allocation to investment in the equity of marketplace lenders. So arguably, in my view, it's a higher risk, higher reward investment. Jeff may disagree in terms of higher risk, but I think it's probably true. Then we look at the invoice finance platforms we'll come on to in a little bit. And then finally, we've got the peer-to-peer platforms, TrustBuddy and Lending Club. Lending Club I've put as a listed entity because we all expect it to IPO in the next couple of weeks. TrustBuddy, I think, is particularly interesting. I think we have Jens Glasso in the audience somewhere. If you want to know more about TrustBuddy, you should talk to Jens. They've got a clear public strategy to diversify away from a short-term, higher rate product towards a more long-term product similar to Lending Club. If you look at the valuation multiples, if you look on 2014 price to revenues, you can see TrustBuddy trading on about 5 times versus Lending Club on about 23 times. You know, we'd be relatively high conviction that TrustBuddy over time will narrow that valuation gap with Lending Club. And therefore, you know, as a listed equity, I think it offers a very good risk reward currently. As I said, if you have any more questions, talk to Jens, just sitting over there. So last but not least, I thought we could talk about what we think is a very interesting example of fintech innovation creating a lot of value. What we've got here is Bassware, a JV with Hourglass announced the month before last. Bassware is an e-invoicing software company. Effectively, their software enables suppliers to communicate with their large corporates, efficiently managing invoices and so on. And Hourglass, a large hedge fund, has provided them with financing capital for the invoices. So under this JV structure, if I'm a supplier, I can go to the Bassware portal, click on a button, finance an invoice with the capital from Hourglass. Now, the upshot of this is that this JV can command a margin of about 2% on outstanding loan balances. When you work it all out, the JV is worth about 2 billion euros. Now, that's interesting because under our assumptions, Bassware own about half of this, which is 1 billion euros of value. Bassware's market cap today is 550 million euros. So it's interesting because the value of the JV to Bassware is 1 billion euros. So just the JV alone implies 70% upside for Bassware, and then obviously getting the rest of the Bassware business for free. So, you know, this is an actionable trade idea. You know, we can check back in 6 or 12 months to see does it actually work or not. But we think this is very interesting. And at Liberum, we're working on a whole bunch of other similarly interesting opportunities. So do get in touch if you want to know more. Thank you.